Whether you understand them or not, the decisions shaping your future wealth are already being made. And the longer you assume there is time to figure them out, the fewer options remain. Money has rules, not written in your country's constitution, not taught in your school, but rules that have silently shaped wealth for over 300 years, and they are operating on you right now. These rules decide who climbs and who stays stuck. And most people have never even heard of them, which means they are already reacting too late to forces that began moving long before they noticed. Have you ever wondered why wealth always moves in the same direction? The rich stay rich, the poor struggle. Middle-class families work harder but fall behind, and with every cycle, the gap seems to widen rather than close. It is not luck, it is not conspiracy, it is law. Invisible laws of money that have existed since the early 1700s. And every time a crisis hits and a recovery follows, those laws quietly select the winners again, while everyone else debates what went wrong. Before we move forward, take a second and drop a comment below, and tell me where you're watching from and what time it is right now. Not as a ritual, but as proof that these rules cross time zones, countries, and generations without asking permission. And that means waiting to notice them has never been a safe position. They do not need your awareness to function. They only need participation. And you are already participating. The first rule has a name that sounds academic but behaves like gravity. It is known as Gresham's law. Once rulers discovered they could mix cheaper metals into gold and silver coins, they made a decision that could not be undone. The moment that choice was made, pure coin stopped being something the public could rely on at the counter, because the system had accepted that quality could be traded for quantity. They stretched supply, diluted value, and hoped no one would notice. But people did notice. They began hoarding the pure coins and spending only the debased ones. And with that simple shift, the good money vanished from circulation while the bad money remained. A door closed in that moment. Trust weakened. Quality retreated. And after that retreat, restoring honest circulation required forcing people to spend what they no longer chose to spend. From that point on, good money could not return to circulation without being surrendered first. That same law still applies today, but the metals are gone, replaced by credit, debt, and trust. Once central banks flood the system with cheap money, when interest rates are low and debt is easy, the option of preserving value by doing nothing starts to disappear, because standing still becomes a losing trade. A similar substitution begins. Inflated, borrowed, devalued money drives out savings, patience, and discipline. People adjust their behavior not because they want to speculate, but because holding still becomes costly. Saving loses ground, and waiting becomes irrational. Stability erodes quietly. And once stability erodes, the system stops rewarding restraint and begins rewarding whoever can move first. Those closest to the source of this new money feel the shift first. Once banks, corporations, and funds receive the early wave of new dollars, the game is no longer about whether prices will change, but about who gets to act before they do. And that timing advantage cannot be redistributed later. They gain leverage before prices adjust. By the time that money reaches you through higher prices, loans, or wages, its value has already thinned, and the dilution has already occurred. The option to capture the early advantage was never yours to begin with. And once the first move has compounded, catching up requires taking on exposure you did not need when quality still held. Gresham's law is not just history. It is your paycheck losing power every year while asset prices climb ahead of it. Once that gap opens, wages cannot close it quickly because they only respond after the price level has already shifted. The decay is not dramatic, but it is persistent. And once purchasing power declines, recovering it requires taking risks you did not need before. That is how options narrow. You do not choose speculation because it is exciting. You choose it because standing still guarantees erosion. And once erosion becomes normal, safety stops being a place and becomes a moving target. The next rule did not arrive as a warning. It arrived as observation. In the 18th century, an economist named Richard Cantillon described what happens when new money enters an economy. And his insight was devastating, because it removed the illusion of neutrality. Once neutrality is gone, you cannot pretend timing is irrelevant, because the order of receipt becomes the hidden hierarchy. Money is never neutral. When it enters the system, it does not lift everyone at once. It moves unevenly, enriching some and eroding others. And once that unevenness begins, it reinforces itself. Imagine water pouring into a field. The areas closest to the source are soaked first, while further out, the soil remains dry. And once the first ground saturates, it changes the terrain for everything that follows. Because the flow keeps finding the easiest channels. By the time moisture spreads outward, the earliest sections have already absorbed more than their share. In modern economies, the financial system is that source. When central banks print money or governments spend heavily, the first recipients gain access before prices fully adjust. Investors, corporations, and asset holders see markets rise, property values surge, and balance sheets strengthen. Workers and savers see something else. They see prices climbing before wages respond, which means the adjustment comes at a cost. And that cost arrives before any promised benefit can. After 2008, the Federal Reserve expanded its balance sheet from under $1 trillion to over $4 trillion in a few years. And the sequence unfolded with precision. Stocks tripled, and the top 1% saw their wealth surge, while median household income remained flat for years, while housing grew more expensive. The policy response stabilized markets by expanding the balance sheet, locking in a distributional shift that could not be reversed without unwinding the rescue itself. And once that lock-in happened, the system became dependent on the higher asset level to justify the rescue. Once asset prices reset higher, any attempt to roll them back threatened the system. So the imbalance hardened. And after that hardening, the only acceptable outcomes were those that preserved the new baseline. Every time governments attempt to fix the economy with cheap credit, they reinforce this structure. Bad money drives out good. The first recipients grow richer, and the last in line absorb the consequences. Once that sequence repeats enough times, the option of a clean reset starts to vanish, because too many balance sheets depend on the continuation of the pattern. You may judge it unfair, but judgment does not alter mechanics. These laws are structural, and structure does not negotiate, it operates. And once it operates through policy, it becomes the condition policy must obey. Pause for a moment and look backward. Every crisis seems to reward the same people, and every recovery pushes asset prices higher than before. Every solution leaves behind a larger balance sheet than the last, and after each expansion, the next response has to begin from that higher level, because going back would break what was just saved. That repetition is not a glitch. It is the outcome of incentives embedded centuries ago, when early economists recognized that money moves toward advantage and compounds where it lands first. There is another law older than both Gresham and Cantillon, and it does not describe flow but concentration. It is called Pareto's Principle, often reduced to the 80-20 rule, and it describes how, in any system, a minority controls a majority of outcomes. In wealth, 20% control 80% of resources, and once capital begins compounding inside that minority, equality of opportunity becomes less relevant because ownership itself becomes the accelerator. When the feedback loops of capital operate long enough, the concentration intensifies. 10% hold more, 5% hold most, 1% commands the system's core. And once that core is held, the rest of the system must route through it. In 1896, Vilfredo Pareto observed that 80% of Italy's land was owned by 20% of its citizens. And he did not treat it as a political anomaly. He treated it as pattern. Once a pattern repeats across domains, the option of treating it as temporary disappears, because the system is revealing its default distribution. Today, the same ratio appears in global wealth, corporate profits, and attention. It persists regardless of policy. But because behavior compounds it, those who understand money multiply it. Those who do not watch it erode through inflation, taxes, and mistimed decisions. Once erosion becomes routine, catching up becomes a permanent chase rather than a destination. Connect these rules and the pattern tightens. Gresham explains decay. Cantillon explains distribution. Pareto explains concentration. Together, they form the invisible foundation of modern finance. And once you see them working as a single machine, the idea of escaping through effort alone loses its credibility. Even revolutions, wars, and crises have not erased it, because each upheaval simply resets the players while preserving the structure. And once the structure survives resets, it stops being an era-specific problem and becomes the environment. By the 19th century, these laws were no longer theoretical. They shaped nations. Industrial revolutions and trade networks expanded under the same quiet mathematics. Those who controlled the money supply controlled outcomes. And once central banking institutionalized issuance, the leverage became formal, meaning power no longer depended on a single ruler's will, but on a system that could keep issuing. Britain's Bank of England issued notes backed by gold, lent to the crown, and expanded money through credit, enabling wars and colonial expansion without waiting for taxes. Every issuance shifted leverage toward those who accessed it first. And once that mechanism funded empire, abandoning it was no longer practical because the state had built obligations that assumed the mechanism would continue. France followed, the Netherlands followed, and the United States followed. By the 20th century, the Cantillon Effect was not accidental, it was strategy. Once credit became a tool of governance, the option of treating money as merely a medium disappeared, because issuance began functioning as policy itself. Central banks managed demand and funded governments with credit, but each intervention increased the size of the central bank balance sheet, further limiting its ability to shrink without destabilizing markets. To stabilize markets today required expanding liabilities that constrained tomorrow. And once liabilities expanded, future stability depended on maintaining their value. Control was temporary. But each act of stabilization traded long-term optionality for short-term survival. And after enough trades, survival required repeating the trade. After enough repetitions, refusing the next rescue stopped being a clean option without breaking what the prior rescues had made necessary. Then came 1971. In 1971, the United States ended dollar convertibility into gold, closing the last link between currency and metal, and money became pure credit. Debt and dollars fused, expanding together. And once that link was severed from gold, the quality constraint disappeared, which meant there was no external break to restore later without breaking what had been built on expansion. Inflation rose, reducing the real value of savings while leaving nominal balances unchanged, and investment turned speculative because holding cash guaranteed decline. The system could no longer revert without collapsing credit markets, so expansion became the default response. And once expansion became default, contraction stopped being a tool and became a threat. In 2008, credit markets froze, central banks printed trillions, and asset prices recovered while workers waited. In 2020, stimulus checks arrived after markets had already begun rising. By the time households spent the money, inflation had already diluted it. Each intervention prevented immediate collapse but deepened structural reliance on credit. And once reliance deepened, the next shock had fewer acceptable responses because markets began pricing in future rescues. The path narrowed. Withdrawal risked crisis. Expansion diluted purchasing power while preserving nominal asset prices. Either way, a cost accrued. And after enough cycles, the cost becomes embedded as the normal price of keeping the system upright. Between 1989 and 2023, the top 1% share of U.S. wealth rose from 23% in 1989 to over 32% by 2023, while the bottom 50% gained little. Each recession accelerated the shift, and each recovery cemented it. Pareto's ratio hardened not through decree, but through repeated proximity to new capital. And once concentration reached a threshold, reversing it required disrupting asset values, which policymakers could not afford. Meaning the policy path became constrained by the distribution it had already produced. These dynamics extend globally because they are mathematical, not national. Japan's low rates enriched corporations and long-term holders. Europe's monetary union shifted wealth toward core economies, and emerging markets felt capital flows dictated by dollar strength. Every region operates under the same laws, and when trust declines, behavior reverts to ancient instinct. People hoard quality. They withdraw from what can be printed and seek what cannot. And once that withdrawal begins, restoring trust without changing the flow becomes harder, because the system is trying to hold confidence while signaling dilution. For policymakers, this creates a trap. To support growth, they expand. Expansion lowers quality, which triggers flight to scarcity. To restore confidence, they contract. Contraction slows growth and threatens asset values. The cycle tightens until confidence becomes the only anchor. And once confidence is the anchor, policy becomes hostage to perception. Confidence is intangible. Once shaken, restoring it requires even larger commitments, further narrowing room to maneuver. And each larger commitment makes the next reversal more expensive to even consider. The system endures because no actor can afford to stop. Governments borrow because voters demand spending. Banks lend because rates incentivize it. Investors chase yield because cash erodes. And workers borrow to maintain living standards. Each choice is rational within the system. And once rational actions depend on prior commitments, backing away stops being a choice and becomes a break. Collectively, they reinforce decay. And the longer the reinforcement continues, the fewer clean exits remain. Now the structure moves into digital form. Central banks are building digital currencies that allow direct issuance and programmable access at the account level, with issuance rules and restrictions embedded in code. But programmable money extends issuance into new channels without altering distribution. Once money becomes programmable, the system gains targeting. But it also inherits a new dependency on code-driven administration, making reversals harder because access and issuance become embedded rules rather than temporary programs. Early receivers remain advantaged, and later participants adjust to conditions already set. Private tokens follow the same arc. Early insiders hold allocation, and as adoption spreads, new entrants pay higher prices. Liquidity expands. Quality projects retreat into wallets while poor ones circulate, echoing Gresham again. And once quality retreats, the market's visible surface becomes dominated by what people are willing to spend rather than what they trust to hold. Global debt has quadrupled since 2000, rising from roughly $80 trillion to over $300 trillion. Central banks now hold trillions in sovereign bonds, acting as both buyer and regulator. They stabilize markets by owning them, a move that preserves order but fuses public balance sheets with private risk. And once that fusion occurs, a sell-off is no longer a neutral option, because the stabilizer is inside the market's pricing. Unwinding debt would fracture collateral values. Expanding indefinitely erodes purchasing power. Management becomes the only option, stretching maturity, suppressing real yields, and sustaining perception. And once management is the only option, the system trades decisive exits for endless maintenance. Once the stabilizer is inside the pricing, stepping away is no longer possible without forcing a repricing that the rescue itself was meant to prevent. Look forward 20 years. If inflation averages 2%, half of today's savings will quietly diminish. If asset inflation outpaces wages, ownership gaps widen further. Pareto's ratio holds, and the minority controls the majority. Governments respond with redistribution and new programs, each requiring funding, each funded by more debt. And once programs become the response, rolling them back becomes politically costly, making the debt path harder to exit. The circle tightens, and each tightening reduces the number of outcomes that can be pursued without destabilizing what already exists. You are not outside this mechanism. Every payment, every loan, every investment reinforces it. And once participation is unavoidable, neutrality stops being a shelter, because the system still prices you into the sequence. The laws of money do not change when platforms do. They only change players. Gresham describes quality loss. Cantillon describes sequence. Pareto describes concentration. Together, they decide who gets rich. Not because they favor individuals, but because they shape flows. And once flows are set, outcomes follow. The world is entering another monetary experiment. Rates rise, debt grows. Confidence becomes the only stabilizer. The same laws will decide outcomes again. Those who understand proximity will adjust earlier. Those who assume stability will discover the shift after it compounds. And once compounding has done its work, the late adjustment is no longer about gaining advantage, but about absorbing the price already set. The window never announces its closing. It simply narrows until only structure remains. The laws of money never change. Only the players do.